What is going on, traders? Welcome back to the Traveling Trader. As we talked about in the last couple of videos, the major earnings season is over, at least as it relates to mega cap stocks. Because of that, the fact that Amazon missed revenue expectations, dragging a whole lot of tech stocks behind it, what's going on with Chinese companies, the rising chatter about the Delta variant, the debt ceiling that is currently set to expire on July 31st. The market is seeing a little bit of toppiness and choppiness once again. Is the big crash imminent? It seems like the conditions are all there for the market to draw down further, to gear up for another round of reopening trades and some tailwinds that are likely going to be sparked by a new massive infrastructure bill. This would also make sense because, as we've talked about before, the summer months are the slowest months in the markets historically. So in this video, we'll talk about the current state of the markets. I'll give you an update on the current plays as always, and then give you some stocks that I'm looking to buy, some stocks that I'm looking at considering the current market landscape. So you definitely want to stick around to the end. Welcome back to the Traveling Trader, your source for non-BS, concise, regular market updates. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what stocks you are looking to trade. I love hearing from you guys. I try to respond to each and every comment. And without further ado, let's get right into it. So is the big crash imminent? Obviously, there are bubbles all around the market. If you look at this chart, for instance, and you could see that companies like Cloudflare, CrowdStrike, Shopify, Zscaler, etc., compared to old school tech companies like Microsoft, Cisco, and Amazon, if you look at the PS ratios, that is the price to sales ratio, you could see that the old school tech companies are trading anywhere between 4 and 13. However, the new internet stocks, .com 2.0 or 3.0, however you put it, we're talking mainly about cybersecurity and cloud-based platforms. They are trading at insane price to sales ratio, meaning that the price of their stock is far exceeding the sales per share. Cloudflare trading at almost 68, CrowdStrike at almost 58, you have Shopify trading at 54, and you have Zscaler trading at almost 51, again, compared to some of these old school legacy internet and tech stocks. You look at the inflation rate here in purple compared to the long-term interest rates, and really, this curve has been higher than it has been at least since the 2008 financial crisis. If you look at the valuations of the top 1,500 companies that are unprofitable in the last 3 years, you could see that we are nearing .com levels. So you marry that with the Delta variant, there are rumblings that we could be facing lockdowns in certain states. European countries could also be facing new lockdowns. The current debt ceiling is going to expire July 31st, and unless there is a bipartisan agreement to raise the debt ceiling, then the US Treasury cannot incur more debt. This limits the amount that the federal government could borrow and could affect certain bills as well as certain spending initiatives going forward, which would mean less liquidity into the market and less liquidity into the economy. And then obviously you have the earnings miss of one of the biggest companies ever created, Amazon. I use the term miss lightly here because they still reported a $113 billion quarter, but analysts were expecting $115.4 billion in revenue, so a slight miss there. However, they did significantly beat earnings expectations with a profit of $15.12 per share versus $12.47. But the market is pricing this in as a foreshadowing of things to come. What I mean by that is that Amazon represents such a huge part of the US retail economy that if Amazon is seeing a slowdown in sales, then that could be a foretelling that the economy itself is slowing down from the boom that it saw post-COVID. As a matter of fact, according to the Seeking Alpha report, the US economy expanded at 6.5% annualized rate in Q2, but the expectations were that we'd see an 8.4% growth. Now, this could be interpreted as a larger than expected drag from supply chain shortages, and that the economy could boom once again once those shortages are alleviated. So as you can see, the recipe is there for a drawdown. Now, will we see a big crash this year? I actually don't think that the big crash will happen this year. I think that'll be reserved for when the Fed raises interest rates once again. However, this double top pattern that we see on the indices, in this case the S&P 500, this is usually followed by a little bit of a drawdown, either to the 21 EMA or the 50 MA, could even go to the 100 MA, since we haven't seen that big of a drawdown in the Dow Jones and the S&P 500 since last November of 2020. And if you recall from one of my videos earlier this week, I said that after the earnings season is done, if you are a short-term trader, you will want to start thinking about trimming or hedging. You could do things like sell covered calls, buy calls against the VIX, buy inverse ETFs, buy calls on inverse ETF options, or buy puts on ETF options themselves. You could sell a portion of your shares if you don't care about the tax burden. There are so many things that you could do other than just sit on your hands here. And as you know, I don't believe in being completely divested from the market. A lot of folks think that pulling their money out of the market is the right idea. In my view, it isn't. As a matter of fact, I saw a statistic that in the last 20 years, if you missed the 10 best trading days in the market over the last 20 years, you essentially would cut your gains by half. That is just missing the 10 best days in the last 20 years. All right, so with that said, I'll give you an update on some of our current plays, and then we'll go over some plays that I'm looking at considering the current market landscape. We actually had one of the best earnings weeks of 2021, had a put butterfly spread on Apple, had a diagonal call spread on Microsoft, had an iron condor on Facebook, which we closed for 70% yesterday, had a Tesla calendar spread that is currently up over 100% at the moment, had a Ford vertical call spread that we closed for 55%, a QCOM diagonal spread that we closed for 51%. We had a call spread on Disney as well that was up 42%. Disney actually has yet to report earnings. They report in the next couple of weeks. But yeah, just an insane week in earnings trades. As a matter of fact, besides the Nike bearish trade, the only other options trade recently that we lost on is the Adobe trade. This one expires August 6th, but I need Adobe to be below $600. It is currently blasting through that $600 range, so we're currently down on this one as well. But yeah, if you want access to all of our trades, link is in the description below. If you've always wanted to learn how to trade options, I put together a course, spent 100 hours on it. That link is also in the description below. Obviously, you can learn how to trade options for free on your own time, but if you are looking for a structured program, consider checking that out. All right, and in terms of some of the plays that I'm looking at, obviously, we're looking at Amazon here, sitting at the 100-day moving average. Also happens to be the 0.236 fib level. Amazon currently trading at around 33.40. Again, I talked about that revenue miss. To me, this is an overreaction, but the market is using Amazon as an example of things potentially to come in terms of an economic slowdown post-COVID. Amazon is currently down over 11%. Obviously, it could fall to even the 300-day moving average at around 3,100, and I would likely continue to dollar cost average here. But this is a discount that you want to take advantage of in your long-term portfolios, in my opinion. Now, another thing I'm going to do, you guys have heard me talk about this spread on the channel, is the 39.50 4,000 spread for Amazon. We are likely going to reopen that, but what I want to do is I want to see a few more candles here. I want to see where Amazon finds support before I open that 39.50 4,000 spread that I'll likely open for the September or October expiration. Another stock that I'm looking at here near the 300-day moving average, and I called this out in the trading group, is Pinterest. Pinterest currently trading at around 59 bucks, just crossed above 60 bucks. This definitely is an overreaction. Pinterest actually beat earnings, but it did see a slowdown in user growth. It is at a major support level that it established in November 2020, hitting almost oversold levels on the RSI. So I am looking to buy the dip on Pinterest here. I might even buy some YOLO call options, since call options are likely very cheap after this huge drop. We've talked about AMD ad nauseum on this channel, but we bought it when it retested the 300 MA below 75 bucks. Currently trading at almost $103, up 35% within a couple of months. Now, if the merger with Xilinx goes through, I expect AMD to comfortably trade in the $100 range and not fall below that really ever again. I'm also looking to initiate a potential short position, at least through options on Snap. I do think Snap really gapped up here without explanation. It climbed 24%, even though it has not yet reported a profit. And I'm also looking to potentially short Moderna. After S&P inclusion, Moderna has just gone insane, has been overbought for quite a while. Now, it is kind of flagging here. I do want to see what pattern it forms here, but I could open up a credit call spread on Moderna. It is reporting earnings next week, and in my view, the earnings will likely be priced in, and the market will interpret the good earnings as COVID tailwinds, which are temporary. Anyway, traders, that is it for this video. In conclusion, I do think we will see a little bit of a market drawdown. I do not think we will see a full-on crash this year. Obviously, I could be wrong, but I'm not going to stay divested out of the market. I will continue to pick and choose our spots and look for undervalued plays regardless of the market conditions. And obviously, we always have options at our disposal to play the short-term plays. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what stocks you are trading. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.